My name is Tsang. In this video, I shall argue that classical economics is built on shaky grounds. I argue that it is time to rethink how markets work. In classical economics, one attempts to write down regularities in economic activities. For example, when the price goes up, supply increases and demand decreases. Another example is that the price of an asset depends on its risk. Many of these regularities are written down mathematically. Using mathematics is great. As long as the assumptions hold, results can be proved from the rules defined. So classical economics is solid like a castle. Nobel Prizes are awarded to acknowledge achievements in economic research. Suppose I tell you the following. If I were the Queen of France, I shall give you €1,000,000. Well, there are no queens in France. Since I'm not the Queen of France, you may not want to pay too much attention to my statement. This is different from the statement that if you give me a fish, I'll sing you a song. A conditional statement is only useful if the conditions could be true. You could give me a fish, but I'm unlikely to become the Queen of France. Now, let us examine some of the assumptions behind classical economics. The first assumption is that every investor is perfectly rational. That means, given any situation, everyone knows what his best course of action is. Every economist knows that this is not true. However, most economic theories are based on it. The second assumption is homogeneity. That is, everyone thinks the same. Again, every economist knows that this is not true, but without this assumption, people found it difficult to discover general rules about the economy. There is an assumption that classical economics do not mention explicitly. It is the implicit assumption that computation is irrelevant. That is, given any situation, not only can everyone work out what is best for him, he can work it out within a reasonable, or perhaps negligible, amount of time. The amount of time involved is never included in economic theories. It is also assumed that everyone can work out things in more or less the same amount of time. Economists know that these assumptions are not true, but they believe that these are good approximations to reality. If these assumptions are far from the reality, then many economic theories would not stand. We know that if a castle is built on shaky ground, then when the ground moves, the castle could sink. Following, we shall take a closer look at the ground that economic theories are built on. We shall explain that the market has changed, which poses serious challenges to economic theories. First, let us examine the fundamental assumption in economics: rationality. Suppose I offer you £10 on one hand and £20 on the other. Which offer would you take? The choice is obvious for a rational decision maker. Suppose I offer you two other choices. I can pay you £100 now, or £10 at the end of each month for 12 months. Which offer would you take? Given basic training and the knowledge of the interest rate, this is not a difficult decision to make. However, to make a rational decision, some training is needed. Let us turn to a more complex situation. Can anyone tell me what the best opening move is in a chess game? Chess is a game in which the rules are clearly defined. Both sides know how the board situation looked like after every possible move, and all the moves available after that. There is no hidden information. Should we therefore assume that a rational player will pick the optimal move? Well, theoretically, one could evaluate all possible moves all the way to the end of each game. Theoretically, that is. In practice, there are far more combinations to compute for today's computers. We wouldn't be able to complete the computation within our lifetime, even if we collect all the computers in the world today. In other words, we are limited by today's computation methods. How does computation affect rationality? Some decisions are trivial, but some decisions require computation. Some computation methods are better than others. For example, some chess-playing programs can find better moves in less time than others. Does it mean that some are more rational than others? Clearly. If so, then the statement "investors are rational" is ambiguous. Perfect rationality is out of the question. The above examples illustrate that all the assumptions that we mentioned above are dubious. Investors are never perfectly rational. It is not even clear what rationality means precisely. Investors are clearly all different. They differ in their knowledge in the state of the world, as well as knowledge in computation. Computation capability matters. In principle, the more time you give a chess program, the better moves it will make. The more computation one invests in, the more rational one becomes in a situation. We have witnessed significant changes in the market in the last few decades. These changes amplify the distance between the above assumptions and reality. To start, computer programs are replacing humans in trading. They are responsible for over 2/3 of the orders today, growing rapidly. Computer programs can trade in milliseconds. A program could react quickly to small price changes. One program's reaction could trigger other programs to trade. This means a small price change would trigger significant price changes. Secondly, many new financial instruments have been created. With instruments such as options and contracts for difference, an investor could increase his leverage. That is, for example, with a capital of £10, he could invest in £1,000 worth of assets. These investors are taking higher risk than before. They also have a bigger impact to the market than their capital enabled them in the past. Thirdly, as data has become abundant, computer programs try to process them more intelligently. Intelligent programs, using machine learning techniques, for example, can find patterns in the data and exploit them. That means a small misjudgment by one trader, whether human or program, could be spotted quickly and exploited. What are the implications of these changes? First of all, price movements are amplified. Through leveraging, a small capital may cause big price movements in the market. Secondly, superfast trading by computers, coupled with machine learning, mean that a small order may cause big price movements. It is important to understand that an investor with high leverage is vulnerable to price movements. That is, a small change in price, especially amplified by algorithmic trading, could easily wipe out a trader who uses high leverage. People familiar with financial markets know that wipeouts could trigger chain reactions, which could lead to unexpected effects such as crashes in the market. Under the homogeneity assumption, classical economics was never interested at individual trader level. Under the perfect rationality assumption, all chain reactions should be within the grasp of rational traders, which is clearly not true. Therefore, these changes in the market highlight the flaws in the assumption in classical economics. Economists believed that the assumptions were good approximations. With changes in the market, what used to be good approximations become less so. Ideally, we want to remove all unnecessary assumptions. But if we do so, how much of the classical economic castle remains? We may have to start from the rubbles. Ideally, we want to study markets as a hard science. Richard Olsen, my research partner, asked how biology as a science started. Biologists started by observing nature. They copied what they saw. They also took measurements in what they observed. With enough data gathered, they started to generalize and developed models. Only after sufficient knowledge was accumulated were they able to discover sophisticated things such as DNAs. We know surprisingly little about how the market actually works. Perhaps we should do what the biologists did at the beginning. Perhaps we should let the data tell us where to go next. Data processing is not a trivial issue. Let us look at an example. How long is the coastline of East Anglia in Britain? I can put a string along the coast on the map and measure the length of this string. But if we zoom in, we'll see that the coastline is actually much longer than we thought. This is because what looked smooth in a large scale could actually be made up of a ragged coastline. The closer we zoom in, the longer the coastline may measure. Similarly, the surface of a piece of metal may be smooth, but it looks ragged at microscopic level. Do the details matter? Sometimes they do, sometimes they don't. Throwing them away is wasteful. Sometimes they may explain certain things that cannot be explained by the bigger picture. With big data, one needs to know when to zoom in and when to look at a bigger picture. Big data do not just demand more computer processing. They demand new analysis methods. We don't know what people might do. But that doesn't stop us studying causal relations. With our knowledge in physics, we should be able to work out the consequences of possible actions. We can study the consequences of putting various weights on various positions in this pile. Perhaps we could study markets like we study physics. We could start by writing down what we know about the market. We should know the rules for processing orders. If we don't, then we should find out. With rules written down, we should be able to say what will happen if someone sells 10,000 shares or 100,000 shares, etc. Market physics should tell us how unstable the market is at any moment. We should be able to build an early warning system this way. Let me emphasize that we are not suggesting prediction here. We are not trying to predict how traders place their orders. Here, we are talking about writing down the rules and reasoning about causal relations. Market rules are man-made. They should be easier to discover than natural rules. The current economic crisis is a testament of the deficiency of modern economic theory and its tools for analysis. We propose to build a platform for research in financial markets. Like Wikipedia, this platform should be owned and developed by the community as a whole. We have witnessed the impact of Wikipedia. Unlike Wikipedia, this platform is not for texts, but for data and computer programs. Researchers from different disciplines can work together to contribute data and computer programs to the system. For example, stock exchanges could deposit their data into the system. An economist could add a risk assessment model written in a program, which could be tested with data in the system. A trader could add a trading strategy, which could be tested with data feed in the system. A computer scientist could add a tool to help others to visualize the data, or to help the trader to analyze the performance of his strategy. These programs must be designed to interact with each other, just like hyperlinks on web pages. With this platform, all researchers will be able to repeat experiments done by others. That would bring finance and economic research a step closer to hard science. All computer programs deposited in this platform must be open source, which means no hidden information, and all operations must be verifiable. As this is a repository of data and computer programs, there is nothing to stop one interacting with them using computer programs. Full automation should speed up research progress. Let me conclude. Classical economics is a castle built on sand. It is only as robust as the unrealistic assumptions that it is built upon. The ground has moved. It has been moved by new financial instruments and also by technology. As a result, the castle is sinking. We need to rebuild. To start, we need to remove all unrealistic assumptions. We should start by observing data, which are results of trading activities. Data do not lie. We should treat market as a hard science, write out its physics. We should build infrastructure to facilitate repeatable experiments and enable researchers from different disciplines to work together. Finally, I would like to share a statement written by Alan Kerman, an eminent economist. He said, "The economic crisis in 2007 and 2008 is a crisis for economic theory. We need to remove unrealistic assumptions in classical economics and study the reality. We should pool our resources together. Why? Because it affects us all.